Imagine a world where Bitcoin, the titan of cryptocurrency, plummets to a mere $1. This isn't just a hypothetical market correction, it's a catastrophic implosion that would vaporize over $2 trillion from the global crypto market. In an instant, a financial cataclysm. Millions of investors, from seasoned traders to everyday individuals, would watch their life savings disappear, their digital portfolios collapsing into worthless pixels. A stark reminder of volatility. Crypto exchanges, overwhelmed by a tsunami of panic selling, would freeze withdrawals, trapping what little value remained, exacerbating the widespread fear and uncertainty. The ripple effect wouldn't stop there. The shockwaves would reverberate through the entire global financial system, threatening stability far beyond the cryptosphere, impacting traditional markets profoundly. Today, Bitcoin stands as a monumental force, held by countless individuals and major institutions alike, a symbol of digital innovation and potential, yet inherently fragile. Its sudden collapse, from its current multi-thousand-dollar valuation to a single dollar, would unleash unprecedented global panic, starting with the very platforms designed to trade it. As the value of Bitcoin plummeted, the first and most immediate casualties would be the crypto exchanges themselves, their sophisticated trading systems buckling under the immense pressure of mass panic selling. The sheer volume of sell orders would overwhelm their infrastructure, leading to inevitable system freezes and crashes, effectively shutting down access for millions of desperate users. Many exchanges, unable to cope with the unprecedented demand and liquidity crisis, would likely shut down temporarily, leaving investors in a terrifying limbo, unable to access their digital assets or mitigate their losses. This immediate paralysis of the trading platforms would only amplify the panic, creating a vicious cycle of fear. With the exchanges in disarray, the full weight of the crash would then fall upon the investors themselves, a devastating blow that would shatter countless financial futures. Millions of individuals, who had poured their life savings into what they believed was a secure digital future, would wake up to find their entire net worth obliterated overnight, a cruel and sudden reversal of fortune. The emotional toll would be immense, as dreams of retirement, home ownership, and financial freedom evaporated. Beyond individual investors, the institutional players, particularly crypto hedge funds, would face immediate catastrophe. These funds, often highly leveraged and deeply invested in Bitcoin and other cryptocurrencies, would experience rapid and irreversible collapses within hours of the crash. Their sophisticated algorithms and risk management strategies would prove utterly useless against such a cataclysmic event, leading to widespread bankruptcies and a profound loss of confidence in the digital asset space. The ripple effect would extend further, impacting the very infrastructure that supports the Bitcoin network. Bitcoin mining companies, which rely on the profitability of mining new blocks to sustain their operations, would find their entire business model rendered obsolete in an instant. The cost of electricity and specialized hardware would far exceed the value of the newly minted Bitcoin, forcing these large-scale mining farms to power down immediately and cease all operations. Thousands of powerful, energy-intensive machines, once humming with purpose, would fall silent, turning vast data centers into expensive, useless relics of a bygone era. The profitability of mining would instantly vanish, making it an unsustainable endeavor. This sudden cessation of mining activities would further destabilize the Bitcoin network itself, as the security and processing power provided by miners would drastically diminish. The integrity of transactions and the overall robustness of the blockchain would come under severe strain, potentially leading to further technical issues and a complete breakdown of trust. The cascading failures, from individual portfolios to institutional funds and mining operations, would paint a grim picture of economic devastation, far exceeding initial market projections. The psychological impact on investors would be profound, fostering a deep-seated distrust in digital assets. Many would be left with nothing but debt and regret, questioning the very foundations of modern finance. The crash would serve as a brutal lesson in market volatility and the inherent risks of speculative investments, leaving an indelible mark on the global financial landscape for years to come. The recovery, if any, would be slow and arduous, requiring a complete overhaul of trust and regulation. This scenario underscores the interconnectedness of the financial world, where a collapse in one sector can trigger a domino effect across seemingly unrelated markets with far-reaching consequences. The initial shockwaves from the crypto market would inevitably breach the walls of traditional finance, creating a crisis of confidence that could lead to broader economic instability and recession. Banks and financial institutions with exposure to crypto assets would face significant write-downs, potentially triggering a credit crunch and tightening of lending standards across the board. The global economy, already fragile, would be plunged into an unprecedented period of uncertainty and turmoil as governments and central banks scramble to contain the fallout from such a monumental financial disaster. The very notion of decentralized finance, once hailed as a revolutionary force, would be severely discredited, leading to a reevaluation of its role and risks within the established financial order. This hypothetical crash serves as a stark warning, a vivid illustration of the potential fragility of even the most robust digital systems. As the initial shock of Bitcoin's plummet to a single dollar reverberated globally, the immediate and most devastating consequence was the catastrophic failure of crypto exchanges, which buckled under the immense pressure. The digital platforms, once bastions of decentralized finance, were suddenly overwhelmed by an unprecedented tsunami of panic selling as millions of desperate investors simultaneously attempted to offload their now worthless digital assets. Trading systems, never designed for such an apocalyptic scenario, were pushed far beyond their operational limits, leading to widespread system crashes, frozen accounts, and ultimately, complete shutdowns. This digital pandemonium left countless investors in utter financial ruin, their life savings, once held securely in digital wallets, obliterated overnight, transforming years of careful accumulation into mere pixels of regret. The impact extended far beyond individual portfolios. Crypto hedge funds, once symbols of audacious digital wealth and innovation, faced immediate and irreversible collapse. These sophisticated entities, heavily invested in Bitcoin and other cryptocurrencies, found themselves unable to withstand the sudden and massive devaluation of their primary assets. Their complex algorithms and risk management strategies proved utterly futile against the sheer force of a market reduced to zero. The intricate global network of Bitcoin mining operations, the very engine powering the entire cryptocurrency ecosystem, also ground to an immediate and deafening halt. As the value of Bitcoin evaporated, mining instantly became an unprofitable endeavor, rendering the vast, specialized investments in high-performance hardware and astronomical energy consumption utterly worthless. Gigantic server farms, once humming with the relentless pursuit of digital gold, fell silent, their purpose extinguished, leaving behind ghost towns of technological obsolescence. The cascading failures, from individual investors watching their dreams dissolve to large-scale enterprises crumbling under the weight of their digital portfolios, painted a grim and terrifying picture. The world grappled with the immediate aftermath of a digital financial Armageddon, where the once bright promise of decentralized wealth had twisted into a global economic nightmare. The digital dream had become a digital disaster, leaving behind a landscape of shattered trust and economic despair. With Bitcoin's value plummeting to a mere dollar, the immediate and profound consequence for mining operations was clear. Mining instantly became an unprofitable endeavor, rendering the vast, specialized investments in high-performance hardware and astronomical energy consumption utterly worthless. The intricate global network of Bitcoin mining operations, the very engine powering the entire cryptocurrency ecosystem, ground to an immediate and deafening halt. Gigantic server farms, once humming with the relentless pursuit of digital gold, fell silent, their purpose extinguished, leaving behind ghost towns of technological obsolescence. The economic viability of mining was predicated on Bitcoin maintaining a certain market value, a threshold that had now been catastrophically breached. Electricity costs, once a manageable operational expense, now far outstripped any potential revenue, forcing an immediate and widespread shutdown of mining rigs across the globe. Thousands of dedicated mining facilities, from small-scale home operations to industrial-sized complexes, were rendered obsolete in an instant, their specialized ASICs and GPUs becoming nothing more than expensive paperweights. The sudden cessation of mining activities had a ripple effect, impacting not just the miners themselves, but also the manufacturers of mining hardware, who saw their order books vanish overnight, and the energy providers who lost a significant industrial consumer base. This collapse of the mining infrastructure further destabilized the Bitcoin network itself, as the reduced number of active miners meant slower transaction processing and increased vulnerability, though at this point, with Bitcoin at $1, the integrity of the network was a secondary concern. The primary focus shifted to the sheer economic devastation and the unraveling of an entire industry built around digital scarcity. The dream of decentralized validation and reward had evaporated, leaving behind a stark landscape of abandoned machinery and unrecoverable investments. The once lucrative pursuit of digital blocks had become a financial black hole, swallowing capital and ambition without mercy. This immediate and widespread shutdown of mining operations underscored the fragility of the entire ecosystem, revealing how deeply intertwined the profitability of mining was with the market price of Bitcoin. It was a stark reminder that even the most robust technological infrastructure could crumble when its economic foundations were utterly destroyed. The silence from these once bustling server farms was deafening, a powerful symbol of the digital winter that had descended upon the crypto world. The energy once consumed by these machines, equivalent to that of small nations, now lay dormant, a testament to the sudden and complete cessation of an economic engine. This pivotal moment marked the end of an era for many, as the pursuit of digital gold became an unprofitable memory. The landscape of global finance had been irrevocably altered, with the echoes of silent mining rigs serving as a grim monument to what once was.